Hello, my name is Mia Niroshan and I'm a tax manager here at Centralis UK. I have over 20 years of tax experience working with 3 of the big 4 across a range of taxes, including corporation tax, private client services, expat taxes, and employment taxes. The purpose of this webinar is to focus on employee benefits and the pitfalls and challenges that employers face when reporting according to HMRC PAYE obligations. There will be a chance for questions at the end, and please feel free to put any questions you have into the chat box. I'd like to cover a couple of areas and mechanisms by which we report employee benefits. First of all, on P11Ds, then PAYE settlement agreements, also known as PSAs, and I'll be talking a little bit around short-term business visitors, also known as STBVs. P11Ds. What are they? I'm going to also talk about the reporting and payment deadlines, benefits that are actually exempt from reporting, common taxable benefits, and some of the pitfalls that employers face. So what is a P11D? In case you're not already aware, a P11D is an end-of-year report to HMRC that we complete and file to record all the benefits that the employees have received that haven't already been put through payroll. These benefits are chargeable to tax on the employee. It's recovered via a change in the tax coding notice, and then the employer pays Class 1A NIC. The NIC is payable by the 22nd of July following the end of the tax year. So, for example, for the 22-23 tax year, that will be paid by the 22nd of July 23, and the filing of the P11D forms themselves have to be filed by the 6th of July following the tax year as well. The 22-23 tax rate for NIC is 14.53%. I thought it would be helpful to actually show you what a P11D looks like in case you haven't already seen one. This is the end of year form that we fill out with the employees' details and employers' details and some of the benefits that need to be reported. Quite a common category is Section H for loans provided to employees, and also private medical treatment is quite a common one. We also have some relocation expenses and an area here for other items, such as mobile phone expenses for private use. What are some exempt benefits that do not need any reporting? Well, these are benefits that are incurred wholly, exclusively and necessarily in the performance of an employee's duties. This can include business travel and subsistence, for example, travel overseas to see clients or suppliers, business entertaining, also known as client entertaining, and obvious things like office supplies. These are all exempt. What are actually taxable benefits to be included? Well, you may have come across this quite often: private medical insurance, gym membership, relocation expenses, but only those that are qualifying above the £8,000 exemption. So this £8,000 exemption means that there is no reporting requirement. Qualifying relocation expenses are deemed to be those like storage, travel, transportation of goods between the old location and the new location, company cars and fuel benefits. We've also got things like employer assets that are transferred to employees at less than market value, because there is a benefit in kind there. Other items are loans provided by employers to employees. Any loans below £10,000 have no reporting or payment requirements. However, if the loans are over £10,000 and they are written off at any point, then this becomes a benefit in kind that is chargeable to tax on the employee and to Class 1 NIC via the payroll. Also, if the interest rate on the loan is either at a lower rate than the HMRC official exchange rate of 2.25%, or it's an interest-free loan, that interest charge that has been forgone is actually to be reportable on a P11D and taxed and NIC'd appropriately. What are some examples of some P11D pitfalls? Essentially, any payments that the employer makes in cash reimbursements to employees, for example, reimbursing phone expenses on personal phone contracts with no evidence of actual business use, no itemisation of bills, those potentially need to be put through payroll rather than put on a P11D. And in gym memberships, again, if the gym membership is in the contract name of the employee, then it needs to be a payroll item. However, if these contracts are either in the name of the employer and the employer pays the provider, for example, Vodafone directly, then it's a P11D item with only tax in Class 1A NIC. If the contract's in the name of the employee and the employer pays the employee, that becomes a cash reimbursement. Another pitfall is often that tax exemptions are not correctly applied, so there is underpayment of tax. For example, there's the £8,000 relocation exemption, the £10,000 loan exemption. It's important that the correct amounts are applied. Also, there is a range of employee insurance benefits that are provided to a lot of employees, and it's important to know how we tax these and when we tax these. For example, group life policies, death in service policies, they're actually tax-free and NIC-free. Because it's a group policy, it's not allocated to each individual. However, if it's a policy such as a critical illness life cover, then any payment of that claim would be paid directly to the employees if needed, which means that when actually the premiums are paid by the employer, that needs to go through payroll. Also, if it's something like income protection insurance, the claim is paid by the payroll, by the employer, so it's taxed at that source and the premiums paid originally are not taxed. We need to watch out for leavers, ensuring that any leavers are recorded so that benefits that continue incorrectly beyond their leaving date are either credit noted or the provider is advised of their leaving date, because unfortunately the employee does not get the benefit of that, does not get the benefit beyond their leaving date. It's important to payroll or P11D correctly because there is an NIC difference. If you payroll those expenses, there's Class 1 employers and employees NIC payable. However, if it's to be put on a P11D, there is only Class 1A NIC payable. And there's a timing difference. Payroll reporting is obviously on a month real-time basis, whereas if 1A NIC is not paid till the 22nd of July following the end of the tax year. What are the consequences of making errors in the reporting? Well, if the item should have been payroll versus putting on a P11D, then potentially you've got to go back to the prior year payroll and amend via an earlier year update any mistakes made and include the benefits there. You'd also then have to amend the P11D if it had been filed. And making these corrections and amendments can result in late filing penalties, late payment interest, and also a potential HMRC inquiry, which obviously puts the company at reputational risk. I'd like to move on to another mechanism of taxing benefits provided to employees, and that's PAYE settlement agreements. These are also known as PSAs. So what I'm going to cover, what is a PSA? What are some of the reporting and payment deadlines? What are examples of tax-exempt benefits, taxable benefits, and some of the challenges and pitfalls that employers face. So what is a PSA? You may already know this, but it is a contract between HMRC and the employer to cover any benefits that are deemed to be minor, irregular, or impractical to tax in any other way. I'll come across some specific benefits shortly. It's used where an employer doesn't want that employee to suffer the tax and NIC on the benefit. They foot the bill essentially. For example, if it's a staff event that they've paid for, they don't want the employee to then have to pay the tax and NIC after they've attended the staff event. Also, it allows the employer on a timing basis to not have to make monthly payments and gross them up. They can actually make one annual payment and cover all the tax and NIC due at the end of the tax year. So when does the contract application have to be made to put the agreement in place? It needs to be made by the 5th of July following the end of the tax year. So essentially next month, the 22-23 tax year. The PSA calculation of the gross up of the tax and the NIC needs to be filed by the 31st of July 23, with any payments made by the 22nd of October. I've shown here some exemptions and inclusions that can be put on the PSA. There are a number of exempt items, for example, trivial benefits like gifts to staff or meals and restaurant meals taken out that are below £50 per person. They are exempt. There is no need for those to be reported. Any annual events held by the company, for example, summer party or a Christmas party, if the combined value is below £150 per head, so for example, if each one was £75 per head, that would be an exempt event. However, if one was 150 and the second one was another £50, that event that was £50 would have to be put on a PSA. Also exempt are meals provided on company premises, for example, Deliveroo costs. As long as they're available to all the teams and they're on site, they are exempt. They should also be still below £50 per person. There shouldn't be a reward for services, for example, working through lunch or late night working. There is also an exemption for qualifying late night taxis. So when are these taxis? Well, HMRC have deemed if taxis are taken after 9 PM, then they're qualifying late night taxis that are exempt. This is because it's unreasonable for an employer to expect an employee to take public transport late at night. Also, there is a quantity exemption, which is as long as the number of taxis are below £60 per year per person, then they're exempt. Anything over this would be taxable. Now, some inclusions. What sort of items would be taxable? So, as I mentioned, anything above the trivial benefits threshold of £50 per person, anything that is irregular, and anything that is impractical to tax. For example, an annual event which has a combined purpose of business and non-business. Here are some other main types of PSA benefits. I've mentioned entertainments and gifts. Incentive awards. These should not be cash because then they're deemed to be earnings and need to be payrolled. If they're non-cash and they're not a reward for services, they don't have to be put on the PSA. If they're taxable annual events, I've just mentioned those with the £150 limit, anything above that. Taxable taxis would be those taxis taken before 9 PM, either commuting from home to office or office to home. If those taxis from before 9 PM are actually business related, then there's no reporting requirement. We can also put non-qualifying relocation costs onto a PSA if the employer wants to foot the bill for the tax and NIC charge. These would be anything that is qualifying over £8,000 exemption and also other non-qualifying costs of any value, for example, council tax, mortgage interest, those sorts of costs related to the relocation. Also, quite a common expense that employers want to gross up for tax and NIC themselves is mobile phone expenses of employees who have a personal phone contract where it cannot be defined as to what element of that is the business purpose. So it is deemed to all be personal use unless there's itemised billing available. What are some of the pitfalls and challenges that employers face on PSAs? Well, a lot of the costs on the PSA are coming from ledgers that have to be analysed for all staff benefits and all staff costs provided. Often something comes up with staff meals, they're a Deliveroo, again, meals to the officers, and they are actually a reward for services, or they're only available to certain teams within the business, or for example, only to directors, then these need to be looked at and potentially reported. Annual events, the £150 I mentioned exemption is there, but it's not just the cost of one of the items, it's the aggregate cost of all the costs related to maybe travel, accommodation, evening entertainment. It's looking at all the elements to apply that £150 exemption to. Staff gifts, again, it's an aggregate of expenses per employee per event. So if there's a birth of a baby or a wedding, it's important for that purpose, for that person's gift, to look at the card, the flowers, clothing, whatever's being provided, and accumulate those. On employee trips, it's looking at the purpose of those trips. So if the company's taken employees out for a summer party, for example, it's looking at the dual purpose of that trip. Is it business related, or is there an element of personal in there? And it's analysing those costs and attributing the cost to each portion. Non-UK resident directors' expenses are a common pitfall and are quite a complex area for tax and NIC, and it's important to look at that separately in terms of what travel costs are, what the accommodation costs are of those non-UK resident directors coming to the UK, either to attend a board meeting or for another purpose. Preparing and supplying a PSA is costly to an employer. And it's important to be aware of this because you're not only providing the benefit, but you're also grossing up the cost for tax and NIC. So the total benefit cost to the employer ends up being almost 100% on top for the tax and NIC. It's also important to include any VAT costs in the cost of the benefit, and that's often forgotten. If this is the first time that you've considered that a PSA could be relevant and helpful, then it's important to make that application by the 5th of July of this year for the 22-23 tax year. Missing that application deadline will mean that HMRC will not accept the contract, and potentially for any retrospective events, you'd have to put those back through the payroll as a means of reporting them. I'd like to move next on to short-term business visitors, also known as STVVs. You may already be aware of this, but if you're not, I'm going to discuss what visitors we cover, who the visitors are, from which countries they come from, the duties they undertake, and actions to be taken by the employer. Firstly, what are the rules? Well, HMRC have put these STVV rules to cover any visitors who are employees coming to the UK for work-related duties. HMRC have enabled employers to apply for an STVV arrangement with HMRC to grant a concession. What is this concession? It's a concession to relax the PAYE reporting and payment deadlines. It's also there to reduce the administrative burden and timing of payments for an employer who don't then have to pay the tax NIC on visitors from day one in the monthly payroll. Instead, they can accumulate all the days that they visited, charge the tax and the NIC at the end of the year, and the concession means that the normal payrolling deadlines are extended to the 31st of May at the end of the tax year. So that's given that extra time rather than having to do this on a monthly basis by the payroll. These STVV rules will only cover where the UK is not the economic employer. It needs to be the overseas employer that foot the bill for the payroll. What are the types of visitors it covers? Well, it's any employees from overseas group entities of the UK company or a UK branch of an overseas entity. Resident and non-resident UK directors do not come under STVV rules at all. If they do need to be payroll for tax and NIC, this is outside of the STVV rules. Which countries are these visitors coming from? Well, this falls into two categories. You have employees who are coming from a country which has a double tax treaty, for example, the USA and Europe, who are expected to visit the UK for 183 days or less per tax year. This includes their travel days as well. If you have visitors coming from day one, we would apply for an arrangement with HMRC called Appendix 4, and no PAYE tax and NIC will due. There will just be a reporting requirement. If you've got employees coming from a country where they're resident, which the UK doesn't have a double tax treaty with, for example, Brazil, and they're expected to visit the UK for less than 60 days per tax year, it has to be less than 60 days, including travel days, then Appendix 8 is put in place as an arrangement with HMRC, because essentially from day one, PAYE tax and NIC will be due, but as the arrangement is in place, as I mentioned earlier, you won't have to report and file until 31st of May following the end of the tax year. When do we need to put these arrangements in place? Well, they need to be put in place ahead of any visits that are made to the UK. Also, if there is an intention for visitors to come in, or you think that it may be applicable, it's also good. It's always good to put this arrangement in place ahead of the visits. What sort of duties does it cover? So it doesn't cover, an STVV arrangement doesn't cover all employee duties. It only requires them to report non-incidental visits to the UK, not merely incidental visits. So on the next slide, I've got some examples of what are non-incidental duties and what are merely incidental duties. So the non-incidental duties are caught by the STVV rules, and it can include management of staff, it can include meetings with clients, employees working on client projects, anything that's to do with the core purpose of their role. These are taxable. However, merely incidental duties, such as meeting new colleagues, attending training sessions, feeding back on employee performance, reading business emails. They're merely incidental, so they do not come under these requirements at all. What are the actions that an employer has to put in place? Well, first of all, obviously they've got to make the application for arrangement, which we are happy to help with. Also, they need to keep a record of all visitors who come to the UK, their names, their job roles, the country they're coming from, so we know whether a treaty applies or not, the days they've spent in the UK, because there could be a split of merely incidental and non-incidental duties. We would only apply salary to the apportionment of the days spent doing the non-incidental duties. So it's important that these records are kept, because if employers have visitors that come over between 60 and 183 days for the tax year, then these reports will need to be made to HMRC, just so that we're monitoring those. Right, some final thoughts at the end of this session. So we come to the end of the session, and these are just some final thoughts on what I've covered today. As you can probably see, employment tax reporting is not easy, and the rules are quite complex. It's important that you get it right, because if you don't, potentially an HMRC inquiry could be raised. This is not only costly in terms of time spent negotiating with HMRC over a number of months sometimes, but it's also costly in terms of late payment penalties, additional tax charges, and interest charges as well, and also a reputational risk, as I mentioned earlier. If you would like our help to undertake a PAYE review, as we have done for some of our clients, please let me know, or let our team know, because we can analyse cash reimbursements to employees, benefits and costs ledgers that are prepared by our accounting teams, and determine the correct treatment, that is putting it on a P11D or a PSA, or putting it through payroll. Also, as you can imagine, this is the peak season for P11D and PSA reporting, with a lot of deadlines coming up next month. So we are able to help you on that as well. There are also advisory projects that we can do with you on advising you on tax efficient remuneration packages, such as relocation packages, flexible benefits packages, and the tax implications of providing those to employees. We can also look at reporting and payment on share-based remuneration provided to employees. And I can cover this in more detail if you do need to discuss this further on a one-to-one basis. I hope you found this session helpful and informative, and I'd like now to go across to some questions that we have on the chat message. So one of the questions that we have is, does life insurance and critical illness payment made by an employer on behalf of an employer fall into a P11D return? Well, essentially, no. Also, sorry, the other question is also, is there a trivial limit on a P11D return similar to PSA? Well, there is not a trivial limit on a P11D return to the PSA. So there's only the trivial benefit limit on a PSA item. The life insurance and critical illness made on by an employer on behalf of an employee fall into a P11D return. Well, no, because they would actually, the premiums would need to be reported through the payroll as and when they're paid. And if you didn't want the employee to suffer the tax and NIC through the payroll on those payments, on those premium payments, then you could put it on a PSA, gross up the costs, tax and NIC, and pay those over directly at the end of the tax year rather than on a monthly payroll. Another question I've just had come in is, if employers take out a team for lunch and it costs below £50 per head, is it taxable? Well, as long as it's not a reward for services, as I mentioned, taking employees out for lunch, for working late through lunch, or working late in the evenings, it isn't taxable. And it shouldn't be a regular event either. So as long as it's the £50 per head exemptions applied, that's absolutely fine. Right, so I think that brings me to the end of this webinar. I'd like to thank you for your time and attention. If you have any questions or would like to discuss anything further on what I've covered, please let me know. I will be sending out a YouTube link to this webinar, and it will also be on LinkedIn, and we will send these out to you within the next couple of days. Thank you.